Hi, my name is Allison Lala. I'm with HRI, and welcome to the webinar. We're going to have Tom Halloran and Rusty Ward. They are the plan consultants from Ward Halloran Group. We're going to discuss the market volatility and also the COVID-19 provision. Right now, I'm going to pass it off to Tom Halloran, and we're going to start the webinar.
Great. Thanks, Allison. So hi, everyone. As Allison said, my name is Tom Halloran, and my partner, Rusty Ward, and I are retirement plan consultants, and I'm going to talk about what's currently happening in the market in this kind of these unprecedented times. And this is a, there's been a lot of volatility, and we want to talk about successful long-term retirement plan saving strategies as a participant in the HRI 401k plan. So I'll just get started here. So the key is we want to keep perspective, and we want everyone that's participating in a retirement plan and in the HRI plan to have a perspective and time horizon as part of their plan. So we want you guys to think about, if your time horizon for your retirement savings is 10 years, 20 years, 30 years down the line, we want to keep that in perspective. As this slide says, downturns are normal and typically short. So market downturns may be unsettling, but history shows stocks have recovered and delivered long-term gains, which has been true. And over the last 35 years, the stock market has fallen 14% on average from high to low each year, but it still managed positive gains in 80% of those calendar years. So the stock market has been choppy, and it historically is choppy. Now that we've experienced, a significant amount of volatility, that choppiness has been exaggerated due to this pandemic we're in right now. But we will get through it, and we want everyone to keep continue their strategy, continue their contributions, and keep that long-term focus.
So Tom, would you recommend stopping contributions or changing the amount you're saving into the 401k during the volatile market?
That's a good question, Allison, and we would recommend when markets are volatile, especially when they're declining on the downside, typically we would recommend keeping your allocation the same, keeping your contribution the same, and if possible, even we would, even if you could increase your contribution if market values are down. Effectively, in these mutual funds that you own in the HRI 401k plan, whichever fund it is, you own shares of individual stocks, or you own individual bonds in these mutual funds, and if these stocks are really down in value, you're buying, with every contribution you make to the plan, you're buying the same assets in those funds at a less expensive price. So keeping your contribution and at the same level, or possibly even increasing it, would be beneficial for you in the long term.
Thank you.
Sure. So again, we want everyone to focus on time in the market and not trying to time the market. And this is a great slide that just talks about the missing up days is just as detrimental as participating in down days, and meaning that if you sell and you're on the sidelines during a recovery, it can be difficult to catch up. Missing even a few of the best days in the market can significantly undermine your performance. And this slide really demonstrates that, where it shows that if for the last 40 years, about a 40-year time horizon here, for the last 40 years, if you invested $10,000 January 1, 1980, and you were in the market, and it's a one-time investment, and this is in the S&P 500, you would have that $10,000 would have appreciated to about $650,000 over that time period. It's a long time, but we are long-term focused. Retirement saving is long-term focused. So, but if you were to just miss the best 5 days, if by somehow you had the worst timing in the world and you decide to sell before each one of the best 5 days of that time period, and buy the next day after that great up day in the market, that $650,000 appreciation, or that ending value, would have declined to about $425,000, which is a big swing for 5 days. Now, if you miss the best 10 days, then that ending value is closer to $325,000, and so forth. So really, if you miss the best 50 days out of that really long time period, you're down to about a $50,000 ending value. So it's really hard to time the market. You have to be right twice. You have to be right when to sell, and you have to be right when to buy. And I have yet to meet anyone that is really good at that. So retirement focused, keep your contributions going, stay in the market, stay in your allocation, and long term, that strategy will work.
How do you know when the top 5 or 10 best days in the market are going to be?
That's the issue. I mean, it is really hard. You don't, and no one really does. There's an old saying in our business, and it's there are people that don't know, and there are people that don't know when they don't know, and that's the truth when it comes to timing. I mean, there's a lot of people out there. You turn on CNBC, who are going to tell you, the market's going to, go down, the market's going to go up, and they're educated guesses, but no one really knows. So, for retirement plan investing, we have to stay in the market. We have to keep a long-term focus, and it doesn't mean you can't adjust your allocation for risk. You could adjust your allocation for risk, but staying in the market and keeping your contributions into your allocation is the best long-term strategy for really anyone.
And on average, how long does it take for stock markets to recover from a drastic fall like the one that occurred at the beginning of the pandemic? And how likely is it to reach the same or above?
On average, we would say that would take about, on average, that would it from the financial crisis, it took roughly 2.5 years to 3 years to recover from going from top to bottom back to where it was at the top. And that's about what we've seen through any correction or recession, has been saying a 2 to 3 year time horizon of getting back to the, and it's very it's difficult to see, but if we you could say that could be 4 years in this scenario. It could be 1 year in today's crisis. Hard to say, but again, keeping that keeping that focus. If you have a 10-year time horizon, and I would say that historically we've seen that the 10-year it's been that the market has come back and then has added a lot of value, in a time period like that.
Okay, I think we're ready to go to the C.A.R.E.S Act provisions. I'm sorry. Rusty, did you want to go over that?
That would be great. Thanks, Allison. Thanks, Tom. Tom spoke about the market volatility and what's been going on recently in the markets. And with the economy coming under pressure due to the pandemic, recently there was enacted a provision in the law called the C.A.R.E.S Act, and the C.A.R.E.S Act did give some relief in retirement assets to plan participants. Any loan or distribution provisions that you have in your current retirement plan still are intact. They've just expanded the options for gaining access to assets inside of a qualified plan, retirement plan, with a withdrawal provision and an expanded loan provision. So to qualify for the expanded provisions with the COVID-19 C.A.R.E.S Act expanded provisions, you do have to have been adversely affected by the disease, either having the disease yourself, a spouse, a loved one, a child, a dependent, or you've been furloughed, you've had a reduction in work hours, you've been unable to work, you've had loss of business, etc. So you do have to have been affected by the pandemic and by the disease. It is a self-certification, so you do have to certify when you take a distribution, if you're using the C.A.R.E.S Act provision expanded rules, that you have been adversely affected by the disease. So on the withdrawal side, they've waived the 10% penalty for folks under 59.5 taking a withdrawal, an actual outright withdrawal from their retirement plans. You can take penalty-free up to $100,000 between January 1 and, well, it's really when the law was enacted. So between now and December 31st. And there is some tax favorable treatment that goes along with that. You do have 3 years to pay the tax on that, or if you do repay the full withdrawal, you can put the money back into the plan within a 3-year period. The other option is to take a loan, and they've loosened the loan provisions where you used to have a $50,000 maximum loan provision. You can now take up to $100,000 as a loan, and you can amortize that over a 5-year period, and you can delay the repayment for a 1-year, starting for a 1-year period. So there are some loosening of the rules and the laws. We have gotten this question a lot. If you have a dependent that may be who has been affected by COVID-19, is that considered a dependent? Does that make you eligible? And the answer is probably. If you do have a dependent that you're taking care of, a loved one, a daughter, a son, obviously would qualify. But there are provisions within the IRS internal code that do say that you do have to be adversely affected. And we've gotten the questions a bunch because people have to self-certify. And the reality is, if you self-certify that someone that you're taking care of as a dependent has been affected adversely and has put financial strain on you, and you're taking a distribution, that would qualify under our interpretation. But again, you may want to talk to your tax professional. And the other thing that we have seen is folks asking about the mandatory distributions. So within a retirement plan, there are the pre-tax portion of a retirement plan. There are what are called RMDs, required minimum distributions. Once you reach the age of 72, that rule actually changed from 70.5 under the C.A.R.E.S Act, which was passed in December of 2019, to age 72. But they've waived the mandatory distribution requirement for 2020. So that's been a nice thing for folks that are retired or nearing retirement. that have attained the age of 72 and taken the mandatory distributions where you're required to take out a certain amount out of your qualified assets on an annual basis. So for 2020, that rule has been waived, which I think is another important fact in action of the C.A.R.E.S Act. Tom, do you have anything else?
Yeah, I just wanted to encourage everyone to reach out to us directly. You know, we're here for we're here as a resource to you, and we want you to take advantage of that. Any we have if you have any operational issues, your statements, you want to talk about something operational, then Slavic will be your best contact, and we have the contact information here for Slavic 401k, who's your record keeper. If you have any questions about investments, you want to talk about what mutual funds are available, you want to talk about your allocation, you want to talk about, you know, appropriate risk for you personally, or you want to talk about your timeline or goals, then we would be a great resource for those types of issues. And then Allison is your direct 401k plan administrator. She can do, she'll help you, you know, for really anything else you need. So
yeah, I'm here for any of the paperwork and any guidance that's needed with the COVID-19 provisions. So if you want to defer your loan, give me a call. I can be reached at the number listed. And also for the distributions and the required minimum distribution, I can help out with that.
Thanks, Allison. Okay, well, thank you all. Thank you for your time. And again, please feel free, we're here to help. Please feel free to reach out.
Thank you so much.
everyone.